On November the 10th, 2021, Bitcoin hit $69,000, its all-time high. That same season, Coinbase was sitting at the top of the App Store charts, ahead of TikTok and YouTube. Think about what that means. The single largest wave of new crypto investors in history arrived in the exact window when prices had never been higher. Within a year, Bitcoin had lost 75% of its value, and most of those new arrivals were deeply underwater. This was not bad luck. It is the most reliable pattern in financial history. The crowd shows up at the top because the top is when buying feels safest. Today on Mind Over Money, why your brain reads maximum danger as maximum safety, the same trap running from tulip bulbs to meme coins, and how to build a defense that does not depend on being smarter than Isaac Newton. Because he failed this test too. Start where the textbooks start. Holland, the 1630s. Tulips were new, exotic, and status-loaded, and rare varieties began changing hands for staggering sums. At the peak in early 1637, contracts for single-prized bulbs were quoted at prices comparable to a fine Amsterdam canal house. Then, in February 1637, at an auction in Haarlem, buyers simply did not show up. Prices collapsed within days. Modern historians argue the damage was smaller than legend says, and that is worth knowing. But the mechanism the legend preserves is real and it has never changed. Price rises pull in buyers, whose buying raises the price, which pulls in more buyers. Nobody in that chain is asking what a tulip is worth. They are asking one question: will someone pay more tomorrow? Economists literally call this greater fool theory. It works until the day the market runs out of fools, and that day is mathematically guaranteed. 1720, London. Shares of the South Sea Company are rocketing, and Isaac Newton, the most celebrated mind in Europe, owns some. Here is the remarkable part. Newton did the smart thing first. He sold in April with a healthy profit, roughly doubling his money. Then he watched from the sidelines as the price kept climbing and his friends kept getting richer. That summer, he cracked. He bought back in near the top with a much larger stake. The bubble burst within weeks, and Newton lost around £20,000, millions in today's money. The story goes that he said he could calculate the motions of the heavenly bodies, but not the madness of people. Whether he really said it, his account statement made the same point. Newton did not lack intelligence or information. He was beaten by something else entirely, and that something has a name. The economist Charles Kindleberger, who wrote the classic history of financial manias, put it in one sentence: there is nothing so disturbing to one's well-being and judgment as to watch a friend get rich. That is the actual engine of FOMO. It is not greed, and it is not a market calculation. It is social pain. Your brain tracks relative standing because for most of human history, falling behind the tribe was a survival threat. So when your coworker triples their money on a coin you passed on, your brain does not file it as a neutral event. It files it as a loss, your loss, and loss aversion kicks in with all the urgency we covered in the day trading episode. Studies of brokerage data show investors are significantly more likely to buy into assets their neighbors and coworkers recently made money on. The purchase is not solving a financial problem, it is relieving a social one, and relief, it turns out, has terrible timing. Here is the cruel geometry of a bubble. Early on, when an asset is genuinely cheap, buying feels terrifying because you are alone. No headlines, no friends bragging, plenty of skeptics calling it garbage. By the top, every signal your social brain uses to detect safety is switched on at maximum. Everyone owns it. The media covers it daily. The skeptics have been wrong for so long, they have gone quiet or converted. Buying now feels like joining a winning team, when in fact, the price is high precisely because everyone has already bought. That is the trap. Consensus is what a top is made of. When the last skeptic converts, there is no one left to buy, and the arithmetic quietly flips. The feeling of safety and the fact of danger peak at exactly the same moment. Your wiring cannot tell them apart, and in 2021, that wiring got the purest stress test ever run. January 2021. GameStop, a struggling mall retailer, becomes the center of a short squeeze organized on Reddit. The stock opens the month around $17. On January 28th, it touches 483. Brokerages crash under sign-up volume, and for 1 week, a video game store is the biggest story on Earth. Notice what the coverage did. Every headline about ordinary people getting rich was, functionally, an advertisement for buying late. Data later showed new account openings and buy orders peaked in the final days of the spike right before the stock gave back most of its gains. The early crowd had a thesis about short interest. The late crowd had a feeling, everyone is getting rich without me, and this is my chance. The thesis made money. The feeling mostly did not, and the same year served up an even purer specimen, an asset with no thesis at all. Dogecoin was created in 2013 as a literal joke, a parody of crypto speculation. In 2021, it rose over 12,000% in 5 months, driven by memes, Elon Musk tweets, and the sheer fun of it. The top arrived with theatrical precision. May 8, 2021, the night Musk hosted Saturday Night Live, the coin's most famous cheerleader, on the biggest stage in America. It traded near 73 cents that weekend, then fell more than 90% over the following year. 9 months later, the pattern repeated in a Super Bowl commercial, Larry David dismissing great inventions through history, while the crypto exchange FTX told viewers, "Don't be like Larry, don't miss out." That ad was FOMO distilled into a slogan, broadcast to 100 million people. Within 9 months, FTX had collapsed in one of the largest frauds in financial history. When missing out is the sales pitch, the product is the top. Now the most instructive case, because it involves a real fund with real returns. Cathie Wood's ARK Innovation ETF returned 152% in 2020, one of the great years in fund history. The performance made her a star, and roughly $14 billion of new investor money flooded in across 2020 and 2021. Here is the problem. Almost all of it arrived after the big gains, near the top. In 2022, the fund fell 67%. Morningstar later calculated that while the fund's own lifetime return was positive, the average dollar invested in it lost money because most dollars showed up late. Across ARK's funds, an estimated $14 billion of shareholder wealth was destroyed over a decade. Read that again. A fund can be up, and its investors can be down, and the entire difference is timing driven by FOMO. Performance chasing is not a quirk. It is the single most reliable way retail investors turn winning products into losing outcomes. This is not anecdote. It is the most consistent finding in fund flow data. 2021, the top of the everything rally, saw more money flow into global stock funds than the previous 19 years combined, roughly $1 trillion in a single year. Crypto exchange signups peaked with price in 2017 and again in 2021. Trading volume in GameStop peaked days before the collapse. Morningstar's Mind the Gap study, which we covered in the day trading episode, finds the average fund investor loses about a percentage point a year to this exact behavior, entering after gains and exiting after losses. Flip it around and the pattern becomes almost funny. The moments when the public is most eager to buy are, by definition, the moments prices are highest. Fear of missing out guarantees you catch the ending. The party metaphor is exact. By the time you can hear the music from the street, it is almost over. So how do you beat wiring that beat Newton? Not with willpower, with structure set up in advance. Defense 1 is the same one that beats every bias we have covered. Automate. Scheduled contributions into boring, diversified holdings buy through manias and crashes alike, which means FOMO never gets a vote. Defense 2 is honest quarantine. If you know you will occasionally chase something exciting, and most people will, give that impulse a fixed budget. 5 or 10% of your portfolio, a play money account, sized so that total loss changes nothing about your life. This is not indulgence, it is engineering. A pressure valve stops the boiler exploding. The investor who lets themselves buy a little of the hot thing inside a hard limit is far safer than the one who abstains perfectly for 2 years and then capitulates with half their savings at the top. The way Newton did. Defense 3. Impose a 48-hour delay on any purchase you discovered through excitement, a friend's gains, a headline, a surging chart. FOMO is urgency. Its entire pitch is that you must act now before the window closes. Real investments do not expire in an afternoon. If it is still a good idea in 2 days, it will still be there. Most of the time, the urge simply dies, which tells you what it was made of. Defense 4. Learn to read popularity as price. Ask one question: how did I hear about this? If the answer is a Super Bowl ad, a talk show, or the fourth friend this month, you are not early, you are the product. The crowd's arrival is not evidence the idea works. It is evidence the idea is expensive. Inverting that one signal, treating mass enthusiasm as a caution light instead of a green light, is the closest thing to a superpower retail investors can have. Let's land this. FOMO is not a character flaw. It is standard equipment. It wiped out the man who invented calculus, and it filled Coinbase's servers the week of the all-time high. You will feel it again, probably this year, and the feeling will be strongest at exactly the wrong moment, because consensus is what tops are made of. You cannot delete the wiring. You can only decide, in advance, that it does not get to place orders. Automation for the core, a hard-capped budget for the fun, 48 hours for anything urgent, and deep suspicion of anything advertised during the Super Bowl. To be clear, this episode is education, not financial advice, so do your own research and talk to a licensed professional before acting. And since everyone is currently asking whether the biggest spending boom in history is the next great top, next time on The Big Picture, is AI a bubble? What the dot-com crash actually teaches, with $725 billion on the line. Subscribe so you don't miss it.